Welcome to Primesetpeak, where financial topics are explained in a simple and beginner-friendly way. Today, we are looking at how economic news can affect markets. Markets often react to information. When new economic data is released, people try to understand what it may mean for prices, business activity, and the wider economy. For example, inflation reports can show whether the cost of goods and services is rising quickly or slowing down. If inflation is high, people may expect central banks to adjust interest rates. Interest rate news is also important. Higher rates can make borrowing more expensive, while lower rates can support more spending and business activity. Employment reports can also influence market sentiment. Strong job numbers may suggest that the economy is active, while weaker numbers may create caution. Other important news include central bank updates, GDP reports, global events, and major policy changes. For beginners, the key idea is this: markets do not move only because of charts or numbers. They also react to expectations, confidence, and new information. That is why economic news can sometimes create quick price movement or changes in overall market mood. At Primesetpeak, our goal is to help users understand these financial concepts clearly and safely. Thanks for watching, and keep learning one step at a time.